Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. The Australian dollar displays a very heavy candle on Tuesday and still seeing a little bit more of an extension on Wednesday as the market pressures the level at 69 cents, posting an 11-week low as core inflation stays sticky. Headline CPI eased to 4% annually from 4.2%, undershooting market expectations of 4.3% and struggling some moderation in price pressures. However, the more important trimmed mean inflation measure, closely watched by the Reserve Bank of Australia, painted a less encouraging picture. Core inflation rose by 0.4% in May, above forecasts of 0.3%, lifting the annual rate to 3.6% from 3.4%. The result keeps underlying inflation well above the RBA's 2% to 3% target range and reinforces concerns that price pressures remain persistent. Attention now shifts to Thursday's labour force report. A softer employment outcome would strengthen the case for an extended pause from the RBA of lifting rates, while a stronger result could revive expectations of further tightening ahead of the crucial Q2 inflation report due on the 29th of July. Markets will also be watching the US PCE inflation data, which is the Federal Reserve's third gauge to inflation, and therefore keep an eye on that. Technically, though, we are oversold, but the ADX is still pointing to a somewhat strong bearish trend. Given the fact that we have taken out some support levels on the way down, the exposure now could be towards May this year, somewhere around the region of the lows of 68 cents. But I do expect to see a trap down here and therefore could catch the bears off guard and see a bull rally. Looking onto the euro, well, I've had to move from a daily, because we can't see little history here, and therefore to the weeklies. And as you can see, the market is now under pressure as the dollar index, which measures the greenback strength against a basket of 6 major currencies, climbs to a 13-month high, as growing expectations of a Federal Reserve rate hike later this year and possibly priced in fully in September. And combined with the persistent geological uncertainty surrounding the US-Iran negotiations, continue to fuel demand for the greenback. The ECB's hawkish stance has offered little support for the market, and therefore we're still expected to see more whipsaw price action from the upcoming personal consumption expenditure, or the PCE index, which will remain crucial in shaping expectations for future Fed policy. So looking at the technicals, we can see the bears. Well, from the weekly and the daily, the trend is relatively strong. And furthermore, if we see a break under 113.40, I did lower it by 20 points, is a concern because we may see a drop down towards the mid 112 area before reversing. We are oversold on the dailies, so do keep an eye on that. Well, little candles coming through now for dollar yen, but it's still struggling to make a new high for this year. Nevertheless, there is still much uncertainty in terms of where we're going to go next. I don't feel the market can really push much higher. It's getting very close from the RSI, and therefore a bull trap could be coming very soon, and expect to see one of these candles come out of play. Turning to the sterling, there is still much uncertainty as political risks mount, and therefore looking at the support line, we need to jump to the weeklies. And as you can see, if we see a break here, which is somewhere around 131.45.60, that could open a way down towards 130 as a potential target. A little bit deeper than I like, but given the fact that we've got an engulfing candle on the weeklies, but there is an inverted hammer on this weekly, so we may see a little bit of a turnaround in terms of support, and therefore look back towards 132. But pressure with the dollar being as it is on its strength, let's see how we play into the rest of this week. When we turn to the commodities, gold, well, we've got a shoulder, head, but the right shoulder not fully formed as an inverse head and shoulders, and therefore, seeing how this pattern plays out, we still need a little bit more to the confirmation side to support any upward case. As it currently looks, we're heading back towards 4,050, and if we see a break there, would give some concern down to 4,000. But that being said, let's see if we can get a right shoulder and a rebound. Wrapping up with oil, there is still a little bit more room to the downside by the looks of this, given the fact that the way the market broke away here in February, March, that we could see it revisit and then reject. So I'm not too far away from actually coming out with a bullish call. Overall, though, the bears are in control, but there is a trap laid or will be soon. Well, that's a wrap. Thank you for joining me. And as always, look out for the Insta report, and I hope you enjoy the great start of the day.